My name is Claude McDougall, and this is Solomon Ali, and we're going to just kind of discuss the concepts of how we grow small to medium-sized companies into cash cows that actually are able to move and grow and thrive and raise the kind of capital necessary in order for them to be NASDAQ companies at some point in time, if that's what they choose to do. So I'm going to ask Solomon just a couple of questions and have an opportunity to have dialogue, and hopefully some of these questions will be questions that you will want to ask if you were interested in buying shares in a company or in a stock, or if you're unaware of how the penny stock market works and why one company would be worth investing in versus another company. So Solomon, yes, why don't we just start first off talking a little bit about why a person would invest in a penny stock.
Well, a penny stock club provides a lot of liquidity. It moves very easily, very quickly. A lot of times it moves just on the rumors of the things that will actually take place and will be happening in a very short period of time.
Okay.
Which allows them to basically multiply their money very quickly.
So you're actually driving the value of the company by information that's being released periodically as the company takes on new contracts and positions?
Well, as the company takes on, basically stock is really driven by revenue, growth, and I like to say rumors. But the rumors have to be true, factual things that will take place. Like when a company is getting ready to purchase another company, normally the target company stock would go down and the acquiring company stock would actually go up in value. But nevertheless, if that acquisition actually works and matures over time, then both companies' value actually increases.
Okay. So the type of investors, the people is this the type of strategy that investors normally just buy in? Because there have been traditional philosophies about investing. You learn about mutual funds, you hear about investing in the stock market. You've seen in 2008 the volatility of what took place in the markets. And now you're talking about investing in a company that's young, that's just getting started, and may or may not have the potential to make it.
Well, what is an IPO, initial public offering? Many times it's with companies that didn't even have a track record. You take a company like Google. It literally had no track record, no proven business model whatsoever. But now look at what it trades today, 6 years later.
That's right.
Okay. Investment banking, we put these deals together, and as we put these deals together, it's to create value. We already know what the end result will actually be. This is why your VC companies get involved in the early stages. We selectively pick and choose companies that are poised to actually grow and have the greatest upside. And that's how you can turn $10,000 into $1 million in a very short period of time.
So what you're saying right now then is that you cherry pick these companies before you even decide whether or not that's one you're going to ride. You're not just hoping this company's going to do well. You've done a due diligence on the front end?
Oh, absolutely. Take a company like NDR. NDR was recently acquired by Universal Bioenergy.
Okay.
When Universal Bioenergy looked at that company, what they discovered was two things. They had 22 of the largest contracts in the United States and abroad with the largest utility companies in the world.
Okay.
22. That's just phenomenal. So that company had already showed a track record of doing over $60, $70 million in the previous years, year after year. So it was already poised for growth. So Universal Bioenergy came in and positioned itself to help them finance their working capital needs and actually position them to be able to go to $1 billion company within the next 12 to 24 months.
So through that acquisition, you had a company like NDR that had already established good contracts.
Absolutely.
They just needed additional funding.
Absolutely.
And so you took another company like Universal Bio that was already operating and there were liquidity.
Absolutely. We took a
put the two companies together.
We took a publicly traded company and we took a private company, merged them together to create some excitement and some real business principles with a real value, thereby increasing the overall public valuation of the company. The company currently is extremely undervalued, And it's just one of those great secrets right now.
So what about when company stocks seem to have drastic swings? Does it mean that the company's on its way out of business, for example? Let's just say when this acquisition took place, this company's stock went up to maybe 40 some odd cents a share. But then that company may go back down in value to, let's just say, 20 cents a share. Is it the company on its way out of business? Is the news just old now? What's actually happening?
Well, if you look at Universal Bioenergy, they only put out news articles, press release of actual events that have taken place. Normally what happens is you get a lot of day traders that come in, they buy the stock, they write it up, and these guys make a great deal of profit. And they got in at a very low level and sold it at the high level, making 300–400% return in a matter of days and weeks.
Okay. So this concept of investing is not really new.
Oh, absolutely not. Been around for hundreds of years.
Why is it not as popular when you hear about the basic retail types of investments like a mutual fund or a stock or an insurance product or variable annuity? Why don't you hear much about this type of investing?
Well, let's look at it from a different angle. You take a hedge fund or an investment club who actually are institutional investors who invest in the early stages, like also VCs. Invest when the
VCs, we're speaking of venture capital?
We're speaking of venture capital companies, investment bankers, the whole gamut. They're able to buy the stock because they buy it in such a large block or quantity that they get it at such a significant discount, which they hold on to it knowing that they're going to actually realize the up.
So it sounds like, and you correct me if I'm wrong, this is an opportunity for smaller companies who normally would not necessarily be able to walk into a bank, get traditional financing, or maybe be able to walk into one of your larger brokerage houses like a Merrill maybe, or Merrill Lynch, or some of the larger brokerage houses and find these types of venture capitals. But it sounds like there's more of a relationship that's being established and there's an attention to the growth of the company.
Well, our objective is, one, if they were to go to an investment banking firm, they would ask them for $1 million to $5 million. It's non-refundable. They will put everything together, do their due diligence, and perhaps that company, based on what they believe their market research has revealed, they will bring that company out and create a market for it. Okay. And perhaps not. If they decide not to, that money is being forfeited. Okay. What we do is we try to take the small to mid-sized companies who already have a proven track record, a good business model, help them to get the capital that they need from young investors who are looking to actually come into situations like this and have huge gains or returns. Although these returns cannot be guaranteed, but in many cases this is exactly what happened. If you just follow the investment banker's model or the venture capitalist model, this is why they continue to make money on each and every deal that they do. It's not that every deal is successful. Sometimes we miss it. But many times we get it right.
So these are these buy and hold for 2-year kind of deals? Or are these deals that you have to stay in for the life of this evolutionary process that takes place in the company? That's or are you able to kind of get in and get out? How does it work?
Claude, that's really up to each and every individual investor. Many of our investors do and follow our simple principle. They come in, they invest, they buy low, they sell high. And in many cases, they're back out of the company within a matter of months. Okay, and that's just their risk tolerance. And in a lot of these cases, when they do this, they have made huge, huge returns. You had mentioned earlier, 2008, a lot of people have suffered a loss in the stock market. You never heard an investment banker crying. You never heard of a venture capitalist crying. You never heard of the hedge fund manager crying. They didn't suffer, most of them did not suffer losses.
So even during a declining market in the most turbulent market times we've seen in our lifetime, you're saying these guys still made money?
That's where the greatest opportunities are.
A lot of deals in, huh?
Absolutely. Our job is to create value, to help these companies to grow and take them to the next level. And To do that, we create complete transparency for the investment community, for the shareholders and things of that nature, and we bring in good, solid transactions and help them to do the acquisitions that they need. We spend perhaps over 90% of our time helping these companies to strategically do acquisitions, get contracts.
So can the average investor get involved in this type of an investment, or is this something that's strictly for accredited investors?
9 times out of 10, it's for accredited investors, individuals who meet that accredited investor status. There are slots where individuals who are not accredited investors may participate, but there are not many slots that are available that they can actually fill.
So it's a very selective process, and you want to make sure that the people that you're engaging in this kind of a process understand very clearly what's taking place.
Well, we have to meet all the rules and regulations. Although we're doing a DPO for many of these companies and we become employees of these companies, we have to do and follow all the rules of the SEC and federal.
Okay. So this is not the old adage of pumping and dumping.
Oh, absolutely not. Because in your scenario of pumping and dumping, there's no substance, there's no value. When we put out a press release, it's substance, it's real acquisitions that are taking place, it's real LOIs that are taking place, it's real possible new contracts that will be developed.
So if you know companies that are really growth potential companies, they have substantive things taking place, they have a potential of an upside swing, great marketing strategies, potential new contracts coming on board, that would be the kind of target company we would look for?
Absolutely. Companies that have government contracts, companies that are seeking Fortune 100 companies as their vendors or suppliers, companies who have some real stability, and they're really poised for growth to create real value. We bring our shareholders in, we make everything transparent, and we show them how value will be created and what that actually means. So you may as well say it looks like this. We educate them through the process of what venture capitalists do and what investment bankers have been doing for them.
Hopefully, Solomon Ali and myself, Claude McDougall, have been able to capture many of the questions that you may have in trying to understand some of the alternative investment projects and programs that exist out there. There are many ways of growing wealth, there are many ways of improving your financial resources, but you need to make sure that you're plugging up to the right people with strategies and concepts that are solid and sound. There's nothing new about it, there's no smoke and mirrors. This too can happen for you. Thank you again, and we'll see you soon.
Bye-bye.